there's lots of political commentators that love to chime in on every single little topic, because they can make a name for themselves. That's the business model of the media these days. But most of it's complete bullshit, especially, well, when it comes to the markets, most of the time it's bullshit, because they try and make it an emotive point rather than factual. They try and make the point from their side rather than actually put across, okay, well, this is what's really going on and this is why it's going on. That is what I want to happen. I want people's knowledge to be built up, but for them to sort of learn things independently as well, and to be able to, at the end of the day, know when they're being bullshitted when they read something. If the US were to default or the dollar were to cease becoming a reserve currency, you should be more concerned about where you're going to find fresh water than what your financial decisions should be.
Hey David, how's it going?
Yeah, not bad, mate. How are you?
Yeah, it's awesome to finally speak to you in person after kind of reading your newsletter here and there for a while now. And it'd be great to kind of, I guess, just kick things off on just the classic, like give us a little rundown on who you are, what you currently do, and then I guess like how the Macrodesiac all started as well.
Yeah, for sure. So I'm David Belle. I am, I guess, I don't like the term macro trader because I think everyone is sort of a macro trader. I'll probably put sort of the economic backdrop as my top priorities when I look at the market. So that's sort of the perspective that I'm coming from. Everything from that, everything else is influenced as well, technical analysis, all the other kind of fundamentals. But that's kind of my thinking of how I approach the markets. And I started thinking about things more like this and kind of had a preference for that side of things when I was at university, because I found that a lot of the lecturers would be saying things theoretically, and I'll be looking at the market and like saying to myself, well, that's not translating into reality. So that's kind of where the interest came for me. It's like, why are markets so disconnected a lot of the time from what the textbooks actually say? And I guess then you get into things like trying to work out positioning. Why does market microstructure move or be affected or affect price in the way that it does? You get into all of these other different things. So I think, all of those components that people may ignore. I've just seen the market ticking up quite a lot here in the position I'm in. But those things, yeah, it's very typical, isn't it? Those things that people might ignore tend to interest me. And I think I know a guy who worked on a big FX desk in London. He was head of the desk. He always said to me, try and think about what others aren't seeing or looking at. And so that's why some of the ideas that I have tend to come off a little bit sort of mental, not conspiratorial or anything like that, just a bit against the grain, tend to look at more second and third order effects. I think a big problem is that many people, take things at face value when they look at markets, when really the risk to reward is what happens in that second and third order, which isn't necessarily predicting. It's just trying to work out, okay, what is the probability here and whether that probability can translate into, I guess, a good trade or at least a good trade idea. I worked in broking, in the mid-market as well, and also retail, which isn't really broking, it's more account management, to be honest. Worked at TradingView as well as the head of UK, head of data, and pretty much head of compliance, I guess. So I've got that kind of fintech exposure as well. And TradingView was, obviously the largest website in the world for finance and investing, bigger than Bloomberg, obviously not by revenue and stuff like that, but in terms of, users and how well known it is, it's pretty much a household name now, I'd say. So that was a very, very interesting experience. Yeah, exactly. So I was there for 2 different stints, actually. I was there for a year in 2016, and then obviously more recently with the actual exponential growth through 2020, 2022, end of 2022. So, yeah, I'm a bit of an all-rounder, but at the end of the day, markets is always what I come back to and how I like to think of things. And I started Macrodesiac when I was leaving broking, because I was on LinkedIn writing like a daily note. I've told this story a billion times, and I was chatting with people who may have been like 2-3 decade veterans in the markets, but they were actually asking me questions and trying to really, really understand my position and saying, "Oh, I didn't know that." Sometimes even, which is quite nice to hear. As long as the thing you're telling them is right, of course, you're not leading them along some bullshit garden path. But Macrodesiac then came about because I thought I relate probably better with retail traders at the end of the day. My following is predominantly retail. I've got a load of institutional and fund guys following me as well and things like that I talk about markets with them. But really, the idea came for Macrodesiac when you kind of just see the general knowledge of the electorate, really, when it comes to economics, markets. There's various different contexts that I can talk about. Probably most recently, the energy stuff is something that people just really don't get. But the whole ethos is to try and improve the general understanding of how markets translate to people's lives, and how traders can really make use of it. But predominantly, it's not really about the traders. I think the trading part is more of how I can monetize Macrodesiac to get to that end goal of wanting to basically improve the intelligence of the general person. And it's about trying to find that access to them as well. But yeah, I think I've got a really, really strong opinion that people need to be taught better about these things, and the data backs it up. I think the Bank of England, or there was the Behaviour Insights team at the Bank of England, or they're like a related think tank or something, and they basically said that it was something like 7 or 8% understood the monetary policy statement when it was like written in its original form. But then if you make it into a visual format, it increases to like 18%. You make it more relatable to them, then it increases to something like 35%. And I think, it's vital that more people understand what is going on with the economy and how things relate. Because if you've probably noticed recently, and sorry, I'm talking a shitload here. You've probably noticed recently that there's lots of there's lots of political commentators that love to chime in on every single little topic, because they can make a name for themselves. That's the business model of the media these days. But most of it's complete bullshit, especially, when it comes to the markets, most of the time it's bullshit because they try and make it an emotive point rather than factual. They try and make the point from their side rather than actually put across, okay, well, this is what's really going on and this is why it's going on. And they remove all the context, So whenever you see headlines about like the pound dropping, for example, it's so over exuberant and what's the word, hysterical, the reactions to it, because there's never any context provided. There's absolutely zero context provided by this media, and then people latch onto it. So yeah, that's my perspective.
Yeah, massively. Yeah, I mean, anytime something moves, or like when something big suddenly happens and then it hits the news, like I have so many friends like, oh my God, like the debt from the pound, or like this Brexit, or like just throw in like buzzword here, buzzword there, like bit of everything. And so yeah, it all definitely gets overhyped. Me, I'm 23 at the moment.
23. So you've just left uni, I'm presuming?
Kind of. I got a bit of a weird story. I'm still technically there.
Right.
But yeah, I'm not at uni at the moment.
Okay. And many of your friends, like, would you say your age group, are they like knowledgeable about markets really at all? I guess from what you said, no.
My general friends, no, not at all. Like I actually, so when I started to get like really obsessed with this, I just started like writing a newsletter as well for fun. So I was kind of like, a few friends like read that, and so I guess like that raised a little bit. Like I obviously I'm like complete beginner as well, but it's something that I like to read about. But I'd say like most of them, literally absolutely no knowledge whatsoever, really. And like to be honest, like not that much like actual desire, I guess, to actually really learn that much. Like probably my friend who knows it the most, he's like someone I met in uni, and his like dad's like, well, was a big asset management CEO. So he's probably the most interested, but that's partly just because like he'll have a chat with his dad, and he's like, "What's going on? Or what do I do?" sort of thing. But yeah, not that many really.
And it's crazy because that's exactly what I find as well. You know, you talk to the everyday person, and they'll understand interest rates, for example, but at such a surface level that they wouldn't be. And this is why IFAs, for example, independent financial advisors, this is why they rip the arse out of the general public. You know, by putting them into specific products, which the general public could go and buy themselves, for example, but the IFAs are charging like 1-2% on top because they just don't know about these things. And it's a sad state of affairs, really, because the economy affects people's lives way more than any kind of. Well, sorry, I should make it more specific. The Bank of England affects people's lives, or your central bank affects people's lives more than most politicians can, because most politicians are just fighting in the centre. Whereas the market cycle doesn't really care about politics. And at the end of the day, the central banks have the control over that market cycle.
I mean, yeah, there's two things you touched on there that, like, well, for one, in terms of like the IFA, so like that's actually how I initially got interested in it, because it was like after March 2020, my dad was kind of like, oh, this is like massive capitulation, probably be a good time to maybe just shift a bit of savings into the market. And we're kind of like trying to translate this over to our financial advisor, and like he just absolutely had like one, no urge to really help or anything, but also just didn't really seem to have a clue. And so we're kind of like, surely, like, what is he even doing? Like, surely we can figure this out. And then we kind of just went from there. We're like, he feels like he's basically just sticking the money in an index fund and then shaving the money off for top for himself. So we end up ditching him then, and that kind of went down the route. But then, I mean, what was the second thing you just? In terms of like politics and the Bank of England. So like, I have a few friends who are like quite political, especially like often the more academic ones are like really like news this, new that, politics that, and so like they'll like get like stressed or like, as you say, like blame something that's happening now on the policy. And I'm like, no, this is like central banks is raising interest rates. Like recessions happen everywhere. Like we're not that worse off compared to many places, or like they're not the reason why like the stock market's crashing or something, or like all this kind of. And it's just like, but it almost like doesn't compute, because you never really like, if you once you get caught into like the kind of, I guess, like the party of politics and like the drama that it is. It definitely feels like you do get disconnected from like what the fundamental drivers are underneath everything. And like, even just like as simple as like the question of like, what is money? Or like, what even is inflation? Like, I remember I was speaking with someone, I was trying to explain some stuff, and I was like, it's like, what is inflation? Like, why do housing prices go up? Or like, why is food getting more expensive? Like, what actually is inflation? Loads of ideas, like bit of politics, but never actually really put any thought into it. And I do think that is definitely most people. Which I mean, I guess is like something you're trying to change. I mean, like a lot of it, I think, is the lingo. And like anytime you try and often learn something like this, it's either like your moon boy YouTuber who's kind of like screaming like, we're going to have another crisis or something, or like do this. Or it's kind of like really, really hard to understand, which is like where you have quite a nice balance, because like you throw in memes, you make it sort of fun. It's like you're not trying to build this like garden wall of behind and hide your knowledge behind that.
Well, exactly, because I think tone and how you speak with people, and this is something that I love to do on LinkedIn, because I don't have a boss anymore, and I don't really care about a lot of corporate clients if they don't like it. Is that I like to speak to people as if, now I don't drink anymore, but when I did drink, I could imagine the conversations that I was having in the pub before I got absolutely smashed. And they would have been much more sort of conversational, a couple of swear words thrown in, not like crude jokes, but, jokes that kind of, not edgy, because that sounds
got an
like
edge.
Yeah, exactly. But like, ones that if you're someone on LinkedIn, you might not like it because you might be afraid that your boss might see you liking something. I like to do that because at the end of the day, that's what people like. That's how people, even if they're corporate, that's how they talk to their friends in private. That's probably even how they talk to their colleagues. But it's some weird thing where online they have to put oh yeah, your best foot forward all the time, and it's like it's total bollocks. It's like no one is like that. So I think the tone that you try and convey your messaging is so important, and that's something that we're trying to like improve on every single day, even because we just find that the things that people that resonate with people all the time, and I can give you a perfect example of this, the things that resonate with people all the time change, especially in a world where most of their information is coming from, you know, social media at the end of the day. So like with TikTok, for example, something we're trying out at the moment is finding literally the trend of that day, and it changes every single day. Is crazy. And then relating it back to finance. So like there was it's so ridiculous. There was a trend, right, of Americans having a go at the UK for how shit their Chinese food was. I don't know if you've seen it, but it's a trend that's literally going on TikTok, right? So I put up a TikTok of, and I can show you it actually. Let me get it up. It's probably better if I just get it up. God's sake, I'm looking at golf TikToks here. That's how pathetic my life's become.
I've actually managed to avoid TikTok. It was interesting. We recently did an event, and one of the speakers was like, a young girl. I think she's like 25, maybe, might even be 23, and she's like basically making millions off it because she just started like hair product and using TikTok. And she is just like, the whole thing was like how actually like valuable TikTok can be if you do it in the right way. Because like how to's, educational stuff can just sort of absolutely blow up. And you can get huge discoverability if you do it right.
It's insane. But, you know, like, it's literally the most stupid meme. And it goes, the writing might be backwards, but it goes, Americans are arguing about Britain's Chinese food. Hang on, what was the last bit say? While their banks are dying. And it's just a chart of, like, the regional banking index. And then him just laughing. Like, it's so dumb, but people love stuff like that. And the reason why I'm doing that is because I want that crowd, or at least one person from that crowd that might, you know, find that relatable trend or find that video because of the algorithm. I want them to go away and, you know, maybe Google what's happening with America's banks. And then their interest develops. And from there, what they'll know is, oh, you know, this guy taught me to go and Google this. Maybe you know some more. And then maybe, you know, they build an affinity with Macrodesiac, because genuinely that is what I want to happen. I want people's knowledge to be built up, but for them to sort of learn things independently as well, and to be able to, at the end of the day, know when they're being bullshitted when they read something. And funnily enough, it actually benefits the central banks and policy, because if people are understanding what's being said in their policy decisions, they're going to probably go out and be able to judge whether they should make a certain decision or not, which then leads to better forecasting going forward, and then leads to, at the end of the day, probably more optimal outcomes for the economy. So I think this next generation, like we really have to try and get it. And there's the easiest way to do that is obviously mentioning housing problems constantly, you know, because that is something that resonates with everyone, no matter what, unless you're obviously, you know, gifted a house or something like that, or which is very, very, very rare. It resonates with everyone, but it's a great way to touch a massive audience and to get them interested in all the other components. So yeah, that's the way that I'm going about it. But yeah, coming back to TikTok, it's fantastic. People slate it all the time, and it's like, well, you're just an idiot, aren't you? Like, just get with the times, you know. But they're slating it ironically on Twitter, which is like, okay, it's literally the same.
Yeah. Yes, I mean, yeah, I mean, Twitter's an interesting as well, because like your kind of stuff as well. Like you're obviously pretty big there, and like money Twitter's getting pretty huge and just all that sort of area. And it's like I quite like Twitter compared to LinkedIn, because it feels like you can be more jokey in a sense. Like, definitely feels like you can be more informal. Like, I still don't feel like I can be as informal on LinkedIn as I can on Twitter. But I mean, I guess that's like part of, I guess, like the confidence you have just like in yourself, like I guess your job, your work, and all that sort of stuff. But yeah, I mean, I'd love to kind of.
I think
Yeah, go for it.
just on that note, I think also it's because I've gone balls deep into never having a boss again. Maybe one day I might have to have a boss and I might have to rein it in. I don't know, but we'll see.
Yeah, well, I mean, yeah, it feels like, I mean, given how Macrodesiac going and like everything you're doing, you're probably safe for now. But
No, hope
yeah, I
so.
want to kind of pivot a bit to kind of like you mentioned one like I think it's like in your recent one as well. Was like what are you seeing or like the others are maybe missing? And so like I'd love it if you could kind of I guess like give like a framework for your like macro larger framework of how you see the world and the markets right now. And then I guess either going on from there or tying in slightly where that differs from where maybe most people think people are, or where your forecasts sort of differ from others.
Um, well, I think it's a very, very big and broad question. I could probably write
Mm.
5 billion words on it. Um, but I think at the end of the day, we've got to remember when it comes to equities what we're sort of looking at. And by the way, we're not advertising Huel here either. This is purely coincidental.
This is
I'm
pure
wearing this t-shirt.
chance.
Yeah, and you're
I'll
slowly
take your
sipping
opinion
on
then,
this.
bottom.
But yeah, I think what we have to remember with markets is, firstly, and it's a very popular line that likes to go around, especially at the moment. If the US were to default or the dollar were to cease becoming a reserve currency, you should be more concerned about where you're going to find fresh water than what your financial decisions should be. And if that were to happen, then just buy equities anyway because you've got nothing else to lose.
Mm.
Secondly, I think that tying in with that, equities and equity indices are designed to go up at the end of the day. If you look at the S&P 500, the weakest company is replaced by the next strongest. So the edge is in really staying long. Now, there are of course tactical shorts that you can play, and I'm kind of short risk at the moment because I'm selling the Australian dollar versus the yen, which is you're taking a traditionally risk off currency in the yen, so being long the yen, and you're selling the more sort of risk sensitive currency in the Australian dollar. That creates a proxy for equities in a certain way, but there's it's far more optimal to stay long equity indices and just reinvest the dividends. Most people should just be doing that. Most people should not be trading even intra-monthly, to be honest. And it's ironic that I say that considering I come from a broking background and a trading background, but it's true, you know.
Mm.
But in terms of a framework and seeing what others aren't, I think looking at what the crowd says and then sort of going against that at the right times is probably the best thing to do. I wish I faded myself on the transitory inflation shout. I thought it would be transitory. Obviously, it wasn't. But there's certain points at which you've got to look at things and say, well, hang on a minute. I think there's more risk to reward in not doing this, or not being long equities or not being short equities, which we're seeing right now. Actually, I think we're seeing it quite a lot in bonds. Actually, we're starting to see people say, okay, I think we could actually start getting long bonds here. And I guess when that relates to crypto specifically, there's a good shout to be long Bitcoin, I think, at the moment. And it's not coming from a perspective of, okay, interest rates might go higher, sending Bitcoin lower. It's coming from the perspective of, okay, what if these banking problems actually do become a lot greater and there is an opportunity of outsized risk reward for Bitcoin, for example? I think the probability is low, but the risk to reward is there if positioned adequately, if that makes sense. So I'm not saying like go pile into Bitcoin. I'm saying work out what the adequate position sizing would be for that particular scenario. There's other scenarios that you absolutely would allocate more to if equities or Bitcoin would drop a lot lower. But right about now is like, okay, well, work out what your potential good position sizing could be for that specific scenario. And that's kind of how I look at it as well, is like, how do these, or how will these specific scenarios play out? Like, I don't just have one trade idea. I have okay, if this happens, then, I might do that. But if this doesn't happen and this happens instead, how likely is it that I should actually get involved in this asset class, or should I buy or sell this asset? Do you see what I mean? So it kind of comes off of a bit of a decision tree at the end of the day. But I think trying to work out, what others aren't seeing comes down to really focusing on what they are looking at, and then thinking of, okay, is their priority correct here? Like at the moment as well, I'll give you another example. Many are looking at Druckenmiller, and he's saying he's short the dollar. But if you look back in history, he's been wrong so many times when he said that, to be either long or short an asset. But people just tend to focus on the now. Okay, he said this, and you've got to focus then on, okay, how much is this confirming my bias or confirming their bias? Like, how much do they just want this to be right, for example, because it benefits their current position? When Druckenmiller could have been short for the last 5-6 months, and now he's just saying it now just to see what the market says, because people know that, because he knows that people listen to him. He could exit tomorrow. We just don't know. But people buy into these biases quite a lot because it benefits them.
I wanna touch on the dollar more in a sec, but can we first can you explain your kind of framework of how you see inflation at the moment? And because my kind of view is, like, at the moment we're in like a short disinflationary period, but like it seems that on like a large perspective, inflation could be here to stay, like say from like a decade perspective. And what's your kind of framework on all that?
Excuse me. I think at the end of the day, it's really going to depend on, and there's quite a nice model called HOPE. I think it's housing, output, unemployment, and I can't even remember. No, sorry. Housing, output, production, employment. Okay. So you probably saw the NFP data today. We haven't faltered on that last bit. And I think until we start seeing employment falter, that's the only time when we're going to start seeing any form of risk of deflation. I think disinflation, yes, there's elements of it, but even on the PCE number for out of the US, personal consumption expenditure number, that ticked up just last week. So we're still seeing like some inflationary elements in the market. And the weird thing is that most of those supply side issues have been driven away now. With like all the containers from China being kept outside the port of LA and things like that. Those issues have subsided now that we've opened the countries up and COVID's not really a thing anymore. So until we start seeing employment go, that's really when we'll start to see any form of unstickiness of inflation, if you like. But the wage data today was quite strong too. NFP was 265k, previous revised down. I think it was 265. Previous was revised down to 165. I could be wrong on the. Let me just double check that first one. Can't believe I'm checking Twitter for the NFP data because it's easier. $253k jobs, and the wage inflation was 0.5%. So you can't really get a disinflationary environment with rising wage growth. It's pretty much impossible.
And so, kind of zooming out, then, I mean, do you have a view on inflation over kind of the next, I guess, because one argument is like obviously the energy, kind of just general commodity shortages over the next 10 years. How much do you believe in that And do you have any view on inflation on kind of the longer time frame?
Well, the only view on inflation you can take over the longer time frame is probably from looking at the 10-year break-even inflation rate. So that's basically the measure of inflation in 10 years' time. That's at 2.19% at the moment. For context, back in pre-pandemic, so when was that? Like January? Was that January 2020 now? It was about
2020?
1.77. Yeah, 1.77, 1.8%. So we're heading in the right direction. And it had a high of 3.0304% at around this time last year as well, actually. So we're coming well down off of that high. Naturally, this can change. Inflation could be like the 70s, where we see sort of a double peak. We see that initial spike and then it drops off and then pushes back up towards the end of the decade, which would be devastating because we've got way, way more. Well, inflation's good for debt, I guess, but the interest rates might not
Well,
be.
it'd be like almost a bit like the 40s more.
40, yes, but the thing about the 40s was that naturally we had the war. So inflating away that wartime debt was actually quite a good thing. Now, the thing about the 40s as well was that we were kind of regaining, a lot of the lost men that went to war and died, I guess. So there's an element of being like the 40s, but the context differs slightly, I guess. The 70s is probably closest purely because of the energy issues. And if you recall, they had the winter of discontent in the 70s, which was, I can't remember the specifics, but we could probably equate our winter recently with the winter of discontent, because I had a fucking energy bill for 1,800 quid over 3 months. And that's a winter of discontent because it's complete bullshit. Like the price was just insane, And so I think, yeah, there's definite parallels to be made from previous. And this is another thing that I think people need to try and look at more is history, but not history just from looking at a chart perspective. Like actually go in and look at the different contexts, because a chart doesn't give you context. A chart gives you price path, but it doesn't provide the ability to, create more foresight. It doesn't let you sort of look at situations in context and really get that subconscious going in your head. Like, okay, I've read about this a few times before. Does this seem like this situation's coming about again? Do you know what I mean? And there's been a few times, like when trading, that because I've done it so much, that sometimes like this weird thing will happen where I just recognize something and just be like, oh yeah, I remember reading this paper from 8 years ago, like, and it's happening. Like, do you know what I mean? Just weird stuff like that. So really, really going through things and looking at context is so important. I can't stress that enough.
You mentioned kind of the energy problems and that sort of stuff. Could you kind of dig into that and what you're looking at there?
Energy problems, what in terms of just the cost? So the problem with energy is that people think that the spot rate is what is traded. So they look at the energy price spiking like massively, and then they look at it coming down. So if you look at the natural gas spot rate, which is the price it is today, if you were to buy it today, then that would show you that energy prices shouldn't be as high as they are. But the thing is that wholesalers hedge, and they hedge for up to 12 months in the future, sometimes more. So if we're looking at a peak in nat gas, for example, so if I go to NG and look at nat gas futures, we saw the peak in nat gas actually in August last year. Okay, so if you can imagine, and that was at $11. So if you can imagine that, and this isn't necessarily directly related to the UK price, but it's similar. But if you can imagine that you've got lots of wholesalers that were hedging really, really far ahead because they didn't know, where the price of nat gas would go, whether it would go even higher. We've probably got until August this year until we start seeing, which isn't that far away, only 3 months, until we start seeing real price alleviations. Because the price of nat gas at the moment in the US anyway is at $2.14, which is a massive decrease on $11. So hopefully, if the energy companies are nice, they'll pass on a hell of a lot of savings to us over the next 18 months. But that's hoping that the Russia situation doesn't escalate even further. But I think we're clear there purely because supply chains recalibrate themselves quite well in this day and age. I think Germany's completely fucked on that front, though, to be quite honest with you. So we'll see. But I think the UK, the US, we've kind of got a bit of leeway here.
Okay. And I want to shift a bit to, well, actually, first, what are your kind of views actually on the dollar at the moment compared to, well, I guess the dollar in general and compared to the pound? Because obviously we've had it's been down a while. Well, it's had a bit of quite a big pullback. It seems that you, I guess, disagreed more with the Trump community. Do you see the dollar kind of revisiting highs or maybe even going higher from here?
Well, I said today that I genuinely don't know why the pound is so strong at the moment, because it is. I'm just looking at the chart of the pound. It's literally as we've been speaking. Oh no, wait, sorry, it's not literally as we've been speaking. Let me just go a little bit smaller. It's just trading above 1.26 at the moment. Bearing in mind that, what was it? Was it September? Was it in September? Yeah, they traded down to the lows. Yeah, September the 26th, I believe. It was trading 1.03. I don't know if it got quite that low on the actual market, but on this feed, I can see it was 1.03. So that's a massive, massive increase over the space of, 7-8 months. And it doesn't really look to be stopping. I wouldn't be surprised to see in a few months, maybe even 2-3 months, the pound versus the dollar at 1.3. So it'd be £1 be worth $1.30. Because the way it's moving at the moment is just crazy, and it's not just dollar weakness at the moment that's being experienced. Because if you look at euro pound, we're trading at lows, and we're literally as we're speaking, about to tick to the lowest price since, or the highest price of the pound versus the euro since December. So it's a very, very weird one, the pound, and it's doing its job quite silently here. But the dollar, I think, what's going on with the dollar is, and we might start seeing it over the next week or two, is that central banks are using something called the FEMA and FX swap lines. And these tend to be used during periods of liquidity crises. Now, obviously, over the last couple of weeks, we've seen, UBS take over Credit Suisse. And we've seen all of the US banks. Sorry, I've got really bad hay fever. I'm not a cokehead. I'm just scratching my nose so much. It's really, really annoying. We've seen obviously all of the crises in the US with the regional banks. Now, in my view, the bigger risk is still with Europe, because they've got a slightly different system of operating in terms of the regulations. The US runs by something called Basel regs, but then so does Europe. But the EBA permits European banks to do something a little bit differently. They permit European banks to run a risk weight of 0, so they don't have to hold any capital against their domestic sovereign bond holdings. Now, this is kind of important because the US has something called the SLR, which was removed. I'm getting way too into it, and it's very complex. It comes down to financial plumbing, but basically it's a protection against complete collapse when it comes to treasury holdings at banks. But the European banks don't have this protection effectively. Now, where the dollar comes into play here is when Credit Suisse was going under, or just before it was going under, the Swiss National Bank, I believe, used the full FEMA facility to translate or do a repo, which is lending the US Treasury, their holdings of US Treasuries back to the Fed in exchange for dollars to liquefy the banking system. So secretly, I think, not so secretly, but like behind the scenes, sort of, there's not been reported massively. There's been quite a lot of fire putting out, which, if this were back in 2008, probably would have resulted in actual financial collapse, like it did, back then. But we've been averting it by these just pure liquidity injections. And have you ever heard of the FEMA before?
The FEMA?
Yeah.
No.
So that facility that I was talking about, most people don't. Yet it was used to its full extent by one entity, like the maximum that one entity could use. No one really knows about it. And then Credit Suisse was taken over straight after, one of the world's biggest investment banks. And that's not strange to anyone. Like, it's literally not been reported on at all, Credit Suisse. Like, it was reported on that week. But if this were back in 2008, it would have been like there for ages. It might even have gone under. It's just people are so willing, and institutions are so willing just to backstop the entire system constantly, that moral hazard, I don't think, is still not left the system. It's just so secret, and just like people just think it's part of business now, just to get the central bank to just provide liquidity, and that's it.
And so I guess then that's where you kind of see that maybe that most of the dollar weakness coming from is just a constant injection of liquidity.
Yeah. I wrote a piece on it actually called Swap Line Bling, because at the time the Drake song was released, I think. And let me get it up. I said it would actually be the People's Bank of China using it first, but probably ended up being the SMB. By the way, we don't know who actually used it. We just know that the facility was used to $60 billion by one counterparty. But yeah, I said that when that was first used, that's when the dollar would start to come off, and it did. So I'm a bit of a ledge on it.
Massive edge.
I've got it here. I can share it with you. I wrote it in June last year. Actually, I thought it was way before that, but no, it was June last year. I'll share it with you. You can share it with the listeners if you like. But it's nice. A good article. Probably one of my better ones, to be honest.
Cool. And so when it comes to kind of like, I guess like the average Joe, which is I guess kind of like your market in terms of readers, and like say like your mates, like if someone's like, I've got X amount of money or I want to start investing, like what do you generally go about telling them?
Focus on just buying a tracker that tracks the S&P 500. Actually, firstly, I say max out your employer's pension. It's basically 100% of. It's basically a how do I put it? Yeah, well, it's basically 100% return straight away, because if they're matching your contribution, that's double all your money straight away. So do that. But yeah, it's in terms of straight up investing, like find an ETF that tracks the S&P 500, preferably that can reinvest your dividends automatically, and just hold that. Like, don't be fucking smart about it, to be honest. Don't, you know what I mean? Because when people start being really, really ultra smart about things, is like when they just get bogged down and they don't even know what they're doing. You are not, at the end of the day, Ray Dalio with, what's it like, 5,000 research associates, some of the smartest minds in the world. Keep it simple. You're not going to outsmart these guys. Like, they are your enemy. And that's what people forget, is like, they think their counterparty is like sometimes like a company or whatever. Your counterparty is other traders trying to get you to lose, because that's how they make money. Like, and at the end of the day, these other traders, the majority of the time, are not retail. Brokers want, and well, market makers more specifically, they want retail traders to trade with their brokerage, because that's flow that they can create a market on and make more money on. They don't want really smart guys. So if you can just try and keep it as simple as possible, and just literally reinvest your income into, an ETF that tracks the S&P 500 every month, don't get ballsy and do anything else with leverage or anything like that. It's just boring though, isn't it? No one wants to do anything boring, but at the end of the day, that's what it is. They want to make 1,000x on a fucking coin called shithole face. Do you know what I mean?
That is true. And in terms
It's the
of kind
truth.
of like the US versus, I guess, like the rest of the world and emerging markets, like, do you think the US is at all overrun in terms of the stock market relative to other areas of the world?
What do you mean overrun? Like by the amount of
Well, in terms
assets,
of,
or
no, more in just like, so like when you, I guess more in terms of how much it's outperformed everywhere, and in terms of how many people say in other countries and in the US who invest in the US versus how little people are currently say like invest, basically like how much money has been piled into there relative to other areas of the world. And do you see any sort of potential outperformance by, I don't know, just like by other emerging, like, do you see any kind of outperformance returning to emerging markets relative to maybe like the US or even like other areas of the Western world? Or do you still see the S&P 500 outperforming everywhere going forward, say over the next 10 years?
well, I actually really like the Nikkei at the moment. I think that is going to be a market that absolutely does fantastically, because if you're looking at it from an interest rate perspective or an interest rate differential perspective, sorry, this hay fever this year is absolutely ruining my life. If you look at it from an interest rate perspective, Japan effectively has a lower risk-free rate hurdle at the moment, which means that Japanese yields are being kept lower than US. So from that very simple perspective, and I said previously, keep it really simple. The interest rate path in the US is much higher than Japan's. What do people like when it comes to equities? They like low interest rates. So
Mm.
there's a trade there, be long Japan, be less long the US, or even, if you want to have a bit of a pairs trade, short the US in terms of maybe the Russell, not financial advice, and be long the Nikkei.
Mm.
I like that if you want to look at an interest rates trade, but don't want to get bogged down in actually trading JGBs, which I would not touch, which are Japanese government bonds, because the Japanese monetary policy has been so unorthodox the last 20, it was 98 they did it, 99, say the last 23, 24 years, that it doesn't look like it can change anytime soon. So that's quite a nice anchor to take there. If you can consider that Japanese yields have to remain relatively anchored at the moment versus US yields, which are likely going to remain elevated, there's a really nice risk-free rate spread almost there that you can make use of. If that spread decreases and comes to zero, then you probably want to exit Japan, get long the US. But
Mm.
that's a trade that I like at the moment.
Okay, nice. So yeah, I mean, as you say, everyone does want to often overcomplicate it and have some magic wand or like make a lot more money than is usually probably feasible. But it does always seem to come back to the classic, literally just stick it in an index fund. And I mean, like, do you ever look at kind of more, I guess, like I don't know, say like if you're going for more small cap value or like dividend index funds, would you just say like completely ignore those and just stick with the standard as well?
Stick with the standard. Like, it just makes life so much easier, especially as well because they tend to be most liquid. Like, if you're looking at most S&P 500 trackers, I'm not going to name them, but if you're in the UK, there's various ones that you can find. If you're a non-professional, you can't access US ETFs, which is a real pain in the fucking ass, to be honest, because they're the lowest expense ratio ones, like
Mm.
SPY and VOO. It'd be great if retail could access those, but just regulations, honestly, this is why I hate regulators. It's just so stupid. stick them in an index fund that tracks the S&P 500. You cannot go wrong. It's literally designed to go up. It's more of a Ponzi than Bitcoin. I'm not even joking. It is. How can something, right? It's insane. It's the best invention ever, of course. But seriously, how can something where you remove the weakest and replace it with the strong each time just because? How can that exist? And then your money just goes up. It's fantastic. It's amazing. One of the greatest pieces of financial bullshittery ever. Genuinely.
Oh man, yeah, fair enough. I
Brilliant.
mean, it's interesting. Like, I get obviously like a range of people on here, and like some people. I mean, you get your more doomsayers who are kind of like I think the last guy I spoke to, he was all kind of commodities. He loved commodities. He loved kind of more, I guess, like Latin America, maybe like some India as well, and not so much a fan of the S&P.
I hope he's got a really, really big research team to look at those companies.
Yeah, well, yeah, no, yeah, I mean, he's Evergreen Gavicle.
Evergreen.
Yeah.
If it's a hedge fund, fair enough, because they specialize in finding those opportunities. If it's some random guy on Twitter, then I'm like, no.
Yeah, no, he was a pretty big. He's quite a big financial boy, to be fair. But no. So like, it was interesting because he was like, index fund S&P is always safest, but he was like, for him, he like prefers more literally just general energy, like throwing in general energy ETFs, oil and gas.
That's a completely different, and this is where I think as well financial media might do a bit of a disservice to the everyday person, because the everyday person might then see some of these equities that these fund managers are buying, but they might not understand the fund manager's mandate. They might not understand what the investors who are investing into his fund are expecting. They might not understand things like the Sharpe ratio or the market beta or anything like that. And they might just pile in thinking, oh yeah, this is all great. And it's like, well, no, for you should just stay in index funds. Maybe have a punt around with 5 to 10% of capital in, if you've got that available in the single stocks, maybe to make some outsized returns. But only capital that you'd say, all right, well, if I lost that, I don't really care. Because most of the time, I mean, if you look at, say, the S&P 500, like 50% of its movement is dominated by 4 or 5 stocks. Like, you're not really going to be able to get any outsized beating of that, to be honest.
And it's kind of like, is the energy sector, is that like an area at all that you're interested in general? I mean, say, like kind of on the other side of a recession, if we do kind of go into one, have you got any thoughts there?
So maybe not so much the energy directly. And again, this might come from, thinking about what others aren't necessarily looking at, but the metals that go into the components of perhaps generating that energy, that's probably where you're going to find the big outsized opportunities, in my view. So like, there's a fund manager that I follow. He's a fucking nutcase, but he's good at what he does. He's massive in lithium at the moment, but he's looking specifically at like Canadian mining companies, but ones that have gone into Australia to mine. I don't know why. I told you he's a nutcase. He lives on an estate in Ireland with like 50 dogs. Like, genuinely, 50 dogs in a Rolls Royce. He's mental. But yeah, he likes lithium companies quite a lot. And I think if you can take a view like that and think, okay, well, what else could go into these components? What else goes into this theme that people might not be looking at now, but very, very smart people might be looking at, and might want to, generate a bit of noise around once they've got their positions on, which absolutely is something that happens, by the way, especially in small caps. Potentially a way that you could look at the market. I don't know, just maybe.
Cool.
But yeah.
Nice. So I mean, coming up on the hour, of course, kind of the 45-minute mark. So I'm just trying to think. I mean, have you got like anything else, I guess, like that you want to kind of leave with the reader for the reader to think about? Because I mean, like biggest takeaway is obviously ignore everything, stick it in the S&P. But like beyond that, do you have anything else you'd like to leave a listener with?
Oof, you put me on the spot there, mate.
Yeah, I know. Sorry, it's a horrible question.
Yeah, actually, I think this is one thing I'm a big proponent of people changing their thinking of. So when I say, okay, what is what are interest rates? Like, what's your definition of what are interest rates? Like, how does it? Yeah, what are interest rates?
The cost of money, in a sense.
That's what everyone says. That's exactly what everyone says, but it's not. Interest rates are the cost of time. All right, and I think if you can take that
Yeah.
concept away
Okay.
and focus more on the cost of time of interest rates, you can understand how the world works and how policy works a lot clearer. Like it tends to be that one little change in thinking can open up quite a lot.
Okay. Yeah, that's interesting. I mean, I guess
Mm,
like cost. Yeah, the cost of money over time. But yeah, I guess because there is no cost if you only had it for a second. It's because you're having it over a period of time.
exactly.
Interesting. All right, that's
Yeah.
something. Yeah, something to think about. And yeah, David, it's been awesome speaking to you. It's a shame about United last night.
Oh, are you a United fan?
Yeah,
Oh right, gee. I thought you were doing that thing where
I
someone likes
wasn't
to
gonna
rub
be
it
like
in.
fuck you.
Yeah, exactly. It was, yeah, it's dire. Do you know what? Our away record is shocking.
Yeah,
Um, I'm still a believer. I know the Qatar Emir's in London at the moment, actually. So the guy that wants to buy us is in London. So that's always a bit of good news. He's meeting Rishi, old Rish, the twat, midget twat, Bellend.
yeah. I just hope some sort of deal goes ahead and they're not just gonna fucking leave it last minute, push prices
He'll,
up.
he'll go ahead. He'll go ahead. There's too much property at stake for it not to.
Yeah, hopefully. I mean, it'd be nice to actually get some money back into the club, sort out facilities. Like from the
Look,
sounds of it, it's just a fucking 40-year-old mess.
I just want to see a front three of Rashford, Mbappe, and fuck it, give me Messi for a season. Like, I don't care. Could you imagine the damage? It would be beautiful. Oh my god!
It would be
Imagine them
gorgeous.
three versus like Huddersfield.
Oh, great!
That'd be brilliant. Oh my god!
Fingers crossed. All right,
That's it.
sick. Well, that's been proper, really interesting speaking to you. Went on some tangents that I wasn't kind of expecting, and yeah, thank you for coming on.
You're more than welcome. Thanks. That was a good chat, mate.
Cool. See you, David, man.
See you later.